Hello students, here is the another video for the subject accountancy for your online class, and I would like to welcome each one who is the beginners in accounting and watching this class 11th accountancy. Students, the book that you have to follow is Arya publication, that is New ISC Accounting Class 11th by Goyals. Well students, we have begun with the first unit titled Evolution of Accounting and Basic Terms of Accounting. The history of accounting is as old as civilization. It was mostly likely shown in Babylonia and Egypt 4000 BC. So people, they expect that the accounting was first been developed by people in Egypt and Babylonia, who recorded payment of wages and taxes on clay tablet. So they used a stone tablet, clay tablet or papyrus to record the wages and taxes to be given to the government and wages to be given to the workers. In Greece, accounting was used to maintain records of revenue received in treasury. Romans used day books to record receipts and payment. So if we look back, even in Greece, they recorded the revenue. Now, the revenue is earning from the sale of goods and services. So the Greece maintained the records of the revenue, and even the Roman used the day books. The day books are separate books to record cash, purchase, sale, and the Romans also started with recording the accounting in the books. If we look back in our own country, India, it was traced back to 23rd century ago. Kautilya, a minister of Chandragupta's kingdom, described how accounting records had to be kept. So Kautilya, one of the renowned minister of Chandragupta's dynasty, he was the first person to teach how the accounting record has to be kept, and he was also the beginner of economist in our country. Now let us look into the three phases of evolution of accounting. So we have learned that evolution of accounting was around 4000 BC in Egypt and Babylonia. So the phase 1, the people followed stewardship accounting, known as Munim system of accounting in our country. Well, the accounting was developed in 15th century, but until the beginning of 19th century, Europe, they ignored the accounting system, and the people even in our country followed the stewardship accounting, which means that the person who is the munim will look into the accounting as if it is their own business. Phase 2. The financial concept based on double entry system came to be recognized with advent of joint stock companies, wherein ownership was separated from the management. The need for shareholders and other interests to be safeguarded was recognized, and accounting information came in the shape of profit and loss account and balance sheet. So in the second phase, they accepted the double entry system. So when we go further into the classes, we'll learn about the debit and credit. So here the ownership and the management were being separated. You must have studied in commerce if you have gone through, and if not, then any company is separate from the owner or the management. The company stands as a individual artificial person, and so to safeguard the interest of shareholders and the various people who are connected with the business, the information needed to be given in form of profit and loss account and balance sheet. Phase 3. Accounting information was generated with the help of management in decision making. The new dimension developed in 20th century called management accounting. So now, without the help of the management's ideas and decision, the business cannot generate profits. So since the information was been given with the help of management decision, the new management or new dimension of accounting, management accounting, evolved. Lastly, the business operates in social environment. Evolution of accounting just can't limit to inform investors and managers alone. Social cost incurred by business, social benefit created by it gave rise to social responsibility accounting. Now, we cannot say that the business is run by you alone. It is run by your surrounding, by the society. So there are some costs which you have to give as social benefit to the society around, like you have to employ your worker in a proper and in a place where they are safe to work. If they meet with any accident during their working period, they have to be given with some kind of benefit. There has to be the reduction, or there has to be reduction in the pollution that comes out from your industry, and all the waste that are hazardous to health should be properly emitted, and the scarce resources like water and woods and coal should be properly used, and proper labor practice, education, human right, and proper payment to the workers should be given. So not only it has to maintain the profit and loss, but also it has to maintain the social cost and give the social benefit to the society. Now let us continue with the basic accounting terms. Assets: anything which is in possession or is the property of a business enterprise, which enables a business enterprise to get cash or benefit in future. So asset is anything that you own, what you have as property, as possession, and you use it to get cash or any benefit in future. Assets may be classified into following categories. Fixed or non-current assets. It refers to those assets which are held for continued use in the business for purpose of producing goods or services and are not meant for sale. Example: machinery, vehicles, computer, etc. These are further classified into. So the first classification of asset is fixed or non-current asset. So the asset which is with you for continuous period of time, and it is for the purpose of producing goods and services, and it is not meant for sale or resale. Well, you can sell it in future, but it is not that you buy a machine, use for 1 week and then sell and then buy again. You have to keep these assets with you for continued period of time for the purpose of producing goods and services. So these are further classified into tangible assets, those assets which can be seen and touched, like machinery, furniture, cash, etc. So the tangible assets have got physical existence. They can be seen and touched. You can feel it, you can see it, you can touch it. The another classification is intangible assets. Those assets which cannot be touched or seen, like patents, copyright, computer software, trademarks, etc. So there are some assets which cannot be seen or touched. It does not have a physical existence. You only can have it as a means of earning money in future, like patent. Like you have made a part of engine and you want to patent it in your name. You have made a software and you want to use that software to be used in your name, and so you get the ownership of that particular asset which cannot be seen or touched. Now let us look into the few examples of fixed asset. Fixed assets are those which is with you for continued use and which helps in production, and it is not for sale. Land, building, factory, furniture, equipment. In future you can sell it to increase your finance, but it is not sold on the daily basis. It helps you to produce different goods and services. Now we can look into the example of tangible assets. Here we have got 6 examples of the assets that we can see, touch, feel: cash, equipment, machinery, physical plant. Now here physical plant is not grass and trees, it is the industries, property, inventory, and few examples of intangible assets which we cannot see, we cannot feel, but it is what we own and it helps to earn money: goodwill, patent, trademark, knowledge. Even knowledge we cannot see, but it is an asset which helps you to earn money, and brands. Current assets. It refers to those assets which are meant for sale or which can be converted into cash. These assets are also called short-lived or active assets, like goods, debtors, stock, etc. So current assets are those assets which are meant for sale and they are converted into cash. Like stock of goods you have, inventory you have, so you can sell it, the goods that you produce, sell it, and you can convert it into cash. Now the debtors are the customers to whom you have sold goods on debt. So as they keep on clearing their debts, you will be able to convert it into cash. Liquid assets. It refers to those assets which are either in form of cash or can be quickly converted into cash, like cash, short-term investments, etc. So the most liquid form is cash itself. So anything which can be easily converted into cash, like cash itself, short-term investment, so you can buy an investment or a bond, or you can buy shares which can be easily converted into cash. That is called as liquid assets. Wasting assets. It refers to those assets which are consumed through being worked or used or gets exhausted with the lapse of time, such as mines, oil wells, patents, etc. So wasting assets are those assets as you consume them, as you use them, it gets exhausted, it gets finished with the lapse of time, like non-renewable resources like coal, gold, even the oil wells, and even the patents. Patents, the intangible asset that you cannot see, has to be renewed. So the patent is given on the yearly basis, limited to a particular year. So as the time passes by, it will get over, or it will get exhausted, or it gets finished. Fictitious or nominal assets. It refers to those assets which cannot be realized in cash or no further benefit can be derived, like advertisement expenses. So fictitious or nominal assets are those assets which we use it, like we use huge amount of advertisements to promote our business, but there is no further cash benefit which can be realized. Now let us look into the difference between fixed or non-current and current asset. So fixed assets are held for continued use and are not meant for resale and cannot be converted into cash within a year, whereas current assets are meant for sale or resale or can be converted into cash within a year. Fixed assets are tougher to liquidate, turn into cash. Current assets are easier to liquidate. Non-current or fixed assets do not form a part of working capital. Current assets are important part of working capital. Now, working capital is the amount invested for the day-to-day working of the business, like paying regular wages, buying fuel, raw material. So since assets are meant for sale, current assets are meant for sale, they are the important part of the working capital for the daily expense or daily day-to-day activities where the money has been invested. Non-current assets include tangible and intangible and long-term investment, whereas current assets include cash and its equivalents, stock and account receivable. Now, as we will go further, we will understand the meaning of account receivable and account. Now, let us look into the examples of current asset. Few examples of current asset. Well, cash and cash equivalent, accounts receivable, prepaid expense, that expense you have already paid. Raw material, inventory, short-term investment. There are many more examples which we will learn further. Liquid assets, which can be easily converted into cash. Certificate of deposit. When you have some you want to take loan from the bank, so you deposit some certificate of your shares or bonds that you have bought from the companies or government. And when you have stock of things like gold, silver, which can be easily converted into cash. Natural resources sometimes are referred to wasting asset because once you extract them, it gets over or exhausted, which are non-renewable like gold, oil, timber, coal and other minerals. Fictitious assets. Fictitious assets, the word fictitious itself says fake. So fictitious assets are not assets in true sense, but this is huge amount of expense that you incur and it is unclaimed in profit and loss account, like discount on issue of debenture and shares. Like company, when they want to raise the finance, they sell their shares in the market, sometimes giving a huge amount of discount which cannot be covered back. To promote your business, you invest a huge amount of money in promotion and advertisement. This is you to get benefit from it, but sometimes your investment in the promotion is so huge that you are unable to get it back claimed in profit and loss account. So such assets are called fake or fictitious or nominal assets. Next we have is operating assets. Operating assets are assets that are required in the daily operation of a business. In other words, operating assets are used to generate revenue from a company's core business activities. Examples of operating assets include cash, stock, building. So any asset which you daily require in your day-to-day working in the business to help you to generate revenue or benefit out of it is called operating assets, like cash, stock. You require factory building, Non-operating assets. Non-operating assets are assets that are not required for daily business operations but can still generate revenue. Examples of non-operating assets include short-term investments, marketable securities, etc. So there are some assets which you do not require to use it in daily basis, but you buy them, keep them, and you can use them to generate revenue. Like you can buy investment, bonds, securities, shares, gold from the market and keep it, and you can still use it to generate revenue even though it is not used in the daily core of business activity. Now students, let us look into the hierarchy of the types of assets that we have learned. The assets are divided in terms of convertibility, like current assets, which can be easily converted into cash and it is meant for sale. Non-current or fixed asset, which is kept for continued period of time and it helps in production and it is not for resale, but it can be sold after a long period of time. Then under the non-current asset, we had the tangible and intangible that comes under the physical existence. Tangible, which can be touched, seen, and intangible, which does not have a physical existence, which cannot be touched or it cannot be seen. Then we looked into the liquid asset, which can be easily converted in form of cash or quickly converted in cash. Wasting assets, as you use it gets exhausted and finished. And then usage. Operating asset, those assets which are daily used for generating revenue, and non-operating assets which are not required to be there daily for generating revenue, but it helps you to generate revenue. I hope you all understood these few basic terms of accounting. Now in the upcoming classes we will take up some more of basic terms of accounting. We have to go and learn about 20-25 of basic terms of accounting before we start the real process of becoming the accountant. I hope you like the video. Keep yourself updated by watching each video that comes up on the site. Thank you for watching.